Okay, let's change the language for a bit, as it's time for our first keynote speaker of the day, telling us about the future of bank treasury and the top 5 priorities for ALM desks. Let us invite to the stage founder of the BTRM, Professor Moorad Choudhry.
Thank you.
Please welcome.
Very much. Thank you. Morning. Hello. Hello, how are you? I haven't started yet. Right, okay, good morning. What a pleasure it is to be in Helsinki this morning. My thanks to the organisers, to ALM Partners, for inviting me to present at your event today. Look, everyone fills up from the back. Have you noticed? Reminds me of my old Latin classes when I was at school a long time ago, 1970s. So the most formidable, the most scary class was the Latin class because of the Latin master. He was a formidable character. You know, he didn't pull any punches. You know, he picked on you mercilessly. But I noticed only after a couple of weeks into the start of the year that he always picked on the lads at the back. So I always sat at the front. So my rule ever since then is fill up from the front. That way you won't get picked on. Right, okay, so here we are. We're going to talk about, that's a joke. You meant to laugh at that one. You laughed when I had a drink, but you didn't laugh when I made a joke. So I'm going to adjust my patter for the Finland audience, right? I'm going to adjust my patter, right? I'm going to try and do the visual gags, right? And leave the jokes for back in London. Right, okay, that's a joke as well. Okay, so we're top 5, this is a serious subject. It's a very serious subject. Top 5 priorities for bank treasurers. Okay, now I know what you're thinking. You're thinking, how can we take seriously anything said by a guy who turns up to a professional event, a conference, wearing bathroom slippers with his tailor-made suit? I know, exactly, I agree. It's not on. That's why I've got to point it out. But hopefully by tomorrow, when you think of what I've been saying, you remember what I said rather than what I wore. Okay, it's foot surgery that I had to have after a football injury that was actually years back. And they said, no, there's no hope. You need surgery on the toe. What is the result? And they made, you know what doctors are like? They made it sound like an in and out job. Local anaesthetic, no problem. You'll be up and about in a day, no problem. What they didn't mention was I couldn't actually wear shoes for 2 weeks, right? And if I'd known that, I would have taken a 2-week holiday, not gone in public anywhere, right? Then I could have just worn the bathroom slippers to my heart's content. And here I am in front of 200 odd people thinking, well, this is a very, very dodgy bloke. What's he doing wearing slippers with a suit? Let's get back to the topic in hand, right? Top 5 ALM priorities, or top 5 priorities for bank treasury, indeed bank boards, bank risk management. Okay, and I'm going to do them in reverse order, time-honored fashion. Okay, reverse order. I'm going to do them. So let's start top 5. In fact, there's a bit of a red herring there. So just to check that you're paying attention, I will ask you how many I actually did list by the end of the session. Okay, so we'll do them in reverse order. So the first one is the first one is our good old-fashioned IRRBB, okay? Interest rate risk in the banking book. Top 5 priorities, I mean, I thought that was a discipline that went back at least to the 70s, right? So we had the Basel paper, BCBS 368 in 2016, and then subsequent to that, we've had it turned into law in different jurisdictions in the European Union. We had the EBA publishing a final report in 2018 on this topic. And then we had another final report in 2022, was it 2023? And then just this year, there was a heat map on IRRBB. One of the big 4 consultants, you know who I'm talking about, one of the big 4 consultants, back in London, just earlier this year, they had a seminar called The Future of IRRBB, Interest Rate Risk in the Banking Book. Future? Come on, why would the future be any different? How about the past and the present? Let's stick to the present. In fact, one of the things I want to talk about in my next list item, the third list item, is how we don't necessarily need more guidance if we just carried on doing what we were supposed to have been doing, we'll still be okay. IRRBB, why is that still a priority? Why can't we just bed that down and make it pretty orthodox and normal? To me, it's reasonably straightforward. To me, it isn't particularly an intellectual challenge. Yeah, in fact, we have a bit of hand-holding now. We have two metrics. We have earning sensitivity, delta NII, and we have present value, or future value, if you like. Present value sensitivity, or delta EVE. Why is that such a problem? And then, of course, we have this a bit more of a sort of conundrum situation with CSRBB, credit spread risk in the banking book. What was the original sin for that? The original sin, no disrespect intended, the original sin was BCBS 368, which talks about CSRBB. It has 4 lines in 34 pages on this topic, and we have to turn that into the rule of law. Great, fantastic, thanks very much. Why is that still on my priority list? You know why it's on my priority list? Because people are still going on about it. It's pretty straightforward. Let's estimate the sensitivity of our 1 year's future earnings because of changes in rates. And separately to that, let's estimate the impact on the net present value of our balance sheet if there's a sudden shock change in rates tomorrow from the central bank. And that, of course, is in a different direction. They're conceptually different metrics. Why is that still a challenge? Why are we still having to attend seminars on it and no disrespect, have subsequent more reports and heat maps, etc., etc.? To me, it's reasonably straightforward. You know, whether you're the most complex bank in the world or the simplest, whether you have hundreds of products on your balance sheet and multi-currency, or you have just a handful and a single currency, it's pretty straightforward. Why is it on my priority list? Because people insist on going on about it. I think it's reasonably straightforward. I'd love to get a challenge on that, but I can't see where the challenge lies, other than, okay, I estimate the sensitivity for earnings, and then I estimate the sensitivity present value, and of course, here's my paradoxical point, this is where the challenge lies, because of course, those two metrics point the balance sheet in different directions. So what are you going to prioritize? You can't prioritize, with the best will in the world, you can't prioritize both of them at the same time under the same rate scenario because they move in different directions, mostly, not for all banks, but mostly, let's say 8 out of 10 banks in the world. They pull in different directions for the same rate scenario, so we're going to have to prioritize one of them. But that's great, that's what we're here to do. Isn't that the role of the ALCO? The ALCO, the Asset Liability Committee, to manage the balance sheet, you know, to make sure it's long-term viable and resilient and survivable? I thought that was their job. So let's keep it on our priority list simply because it refuses to go away. It refuses to become something normal and ordinary, which is what it should be. Okay? So let's start with that. Oh, by the way, is there a time on here? Can we get a timing up on here? Otherwise, I have to look at my watch to check the time. And if I keep looking at my watch, you're going to think, is he getting bored? But wait a minute, he's the one that's talking. He's boring himself. So if we can get a time up on here, that would really help me. If not, no problem, I'll check the watch because I don't want to overdo my time. So that's the first item, IRRBB. Okay, let's keep it on our priorities simply because we want to bed it down and we want to make sure that the board understand it. And to make sure the board understands it, we have to make sure ALCO, the Asset Liability Committee, is on top of it. So let's get on top of it, make it something that's really straightforward, do all the behavioral modeling you want to do, blah, 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 okay? You know, you can attend whole 3-day conferences on NMD, behavioral modeling. I'm going to lose the will to live. Come on, let's get this done. Let's keep it on the priority list so we can put it to bed and make it orthodox, ordinary, day to day, not business as usual. Right, now let's really get on to the real big priorities. Number 4, or is it number 2? Number 4, what did I mention just now? ALCO governance, the Asset Liability Committee. Now, my old boss at RBS, the group treasurer there, he had a great saying, which people now attribute to me, but it was him that originally told me this when he recruited me years back. The balance sheet is everything. The balance sheet is everything. We can get a lot wrong as banks. Just look around the world at all the banks that have been fined for all kinds of bad practice, nefarious practice, sanctions evasion, money laundering, rigging markets, LIBOR rigging, blah, blah, blah. All the fines get multi-billion-dollar fines, but they carry on. No harm done. They carry on. Shareholders lose a bit of value. Maybe they have to sell the private jet, but, you know, things carry on. They get the balance sheet wrong, they fall over. Whether it's in 2007 with Northern Rock, in 2007 with Bear Stearns, 2007 with Northern Rock, Lehman Brothers, Citibank, RBS, and then, of course, 3 years ago, we had a cabal of seriously incompetently run banks in the US, the good old USFA, starting with Silicon Valley Bank. I'm going to come back to Silicon Valley Bank right now on this topic. ALCO governance is very, very important. That's a genuine priority for any bank in the world, whether one is in London, in Helsinki, in Harare, in Dhaka, in New York. Asset Liability Committee is the most important executive, or indeed any committee in the bank. Why? Because it manages the balance sheet. And the balance sheet is everything. We get the capital or the liquidity or both wrong at any time for any reason. We get them wrong, the bank falls over. And that, of course, is not where we want to be. So let's keep that on our priority list, because we have to make sure the governance is fit for purpose. And here is my point. I authored an academic paper. Now, why did I laugh just then? Because academic papers don't really get read by anyone, do they? I mean, maybe 1 out of 100, like Black-Scholes or Modigliani Miller, Merton, all these, Vasicek, every once in a while you get an academic paper that other people actually read. Most of them are read by the journal editor, the author, the blind peer reviewers, and of course the author's mum. But I wrote, see, that was a joke. Okay, right. Now, although I was serious, most papers aren't read by that many people. But I wrote one from a couple of years ago in the Journal of Risk Management in Financial Institutions. You don't read that journal? No. So the Journal of Risk Management in Financial Institutions, the paper that appeared in that from 2 years ago, and it was called, Best Practice for Balance Sheet Management. And as part of the study into that, I looked at the ALCO governance framework, the Asset Liability Governance Framework, for a bunch of failed banks from 07, 08, 09. Let's not forget 09. KBC Bank needed a government bailout from the Belgian government in Q1 09, so 09 as well. That's something I know about because I was the treasurer of the bank's investment bank from 03 to 08. But you can't blame me because I'd left before they needed the bailout. So to 09, and then of course bringing it right up to date, 2023 as well. And there's a handy little table in the article that looks at the governance framework for the ALCO for all these failed banks. And at best, the committee is 2 steps below the board of directors. And I don't mind whether it's a continental European model with a dual board structure, supervisory board, executive board, or the more what they call Anglo-Saxon unitary board model, when they have a board and then the executive committee or management committee reporting to that. Leave that aside. At best, it's 3 levels below. You've got a board, a management or executive committee, and you've got the asset liability committee. Silicon Valley Bank, bless them, bless their cotton socks. The ALCO reported to a finance committee, which reported to the board risk committee, which reported to the board. So, that's 100 miles, a million miles away from where it needs to be. Let's assume that the bank, that bank's failure, which we've all read about, we've all looked at it, we've all dissected it, we've seen how their mismanagement of interest rate risk over a period of time resulted in a loss of confidence in the bank, which resulted in a bank run, which resulted in in the demise of the bank. The bank run was helped unknowingly by the funding structure of that bank, which was about 85%. The non-equity liability of that bank was about 80 to 85% operational deposits, what we call MTAs. In England we call them current accounts, in America they call them checking accounts, and the customers were large corporate customers. In fact, they weren't just large corporate customers, they were large non-bank FI corporate customers. That really well-known group of stable, loyal customers, right, founded all that, supplied most of their funding. And so they were well positioned to suffer from a bank run because of their funding base. So the mismanagement of interest rate risk resulted in a loss of confidence, which resulted in the outflow, bank run, which resulted in their demise. Quick aside on that, by the way. This is relevant to the ALCO point. I'm still on number 4, or is it number 2? A quick aside on this. I got into a debate with an American gentleman who was saying, look at these failed banks. Basel, why do we need Basel III liquidity? They didn't save it. He said, he was saying on his social media that, Basel III liquidity, LCR, liquidity coverage ratio, didn't save them. So I said, you may have a point, I mean, notwithstanding that they weren't obliged to be compliant with it, but they did report it internally. I've seen some data on that. But I said, you may have a point. Indeed, if at the time of their demise, their liquidity coverage ratio was above 100%, you may have a point. Look at Basel III, all this stuff from Switzerland that American banks have to follow, or some of them do, the large ones. Wouldn't have saved them. You may have a point. And then he left it at that, and me left it at that. And then I went out, I got it. I did some delving, some digging, and I found for both SVB and for First Republic Bank, the other bank that failed more or less at the same time or just after, their LCR had been consistently below 70% all through 2022. In fact, from end of 2021 onwards. So actually, he didn't have a point at all, did he? It actually acted like a good early warning indicator, didn't it? So I don't just, credit where credit's due. If you're running a liquidity coverage ratio that is at 70-odd% and dropping, if you look at the chart, I've got a nice graph from their own internal data that shows the LCR dipping like that, and it stays around 70, and then they just die. So actually, that's not a bad early warning indicator, is it? All year we've been running an LCR of 70%. Do you reckon that makes us less resilient in a bank run? Let me think. Anyway, to get back, I pointed this out, and naturally he then disappeared from the debate. So to get back to the ALCO governance framework, let's assume that the members of that committee knew what they were doing. I mean, they weren't just serially incompetent or indeed criminally negligent. Let's assume that they knew what they were doing. They pointed out the risks, the structural rate and liquidity risks that the bank was running over a period of time, all through 2022. Let's assume they were doing that. How is one able to communicate that message? Great, thank you. Timer, fantastic, love that, thank you. I really appreciate that. How is one able to communicate that up to the board effectively if one is 4 levels below it? The message is lost, not in translation, but in distance. So we're running a non-resilient balance sheet structure. Okay, we're making the same mistakes that banks made in 2008, and indeed and this is closer to home for them, their savings and loan industry made in the early 80s, when they were doing very long-dated fixed-rate lending funded by very short-dated floating-rate funding. They made this, and so when the Federal Reserve raised rates aggressively in early 1980, 81, their business model suffered, and a lot of them went bust. Another debate I was having, coincidentally, another American gentleman said the blame has to be laid at the door of the Federal Reserve. They shouldn't have raised interest rates. That's a bit like saying, why did that car crash? Well, the traffic lights changed to red. That's why it crashed. He wasn't able to stop. But I thought that's what traffic lights did. I thought they moved from green to red and back again. A bit like interest rates. They go up, they go down. That's what central banks do. They move rates up and down. Okay? Blaming the Federal Reserve for the bank's demise is a bit like saying it's blaming the traffic light for the car crash because it changed to red when you weren't expecting it. Okay, it's just insanity. It's garbage logic, right? But to get back on track here, but I'm looking at the timer. To get back on track here, this is my point. If you're going to really believe that the balance sheet is everything, your ALCO, your Asset Liability Committee, which is the one that manages the balance sheet, I'm thinking, has to be able to communicate with the board at a close enough distance such that any messages of importance are not lost. I can only conclude, there's only 2 conclusions. Either the ALCO was genuinely incompetent, or they were just grifters. They were just, charlatans. They were trying to win something when they knew it couldn't win, right? They're trying to just say, I'll tell you what, we'll run this structure, and if we're lucky, we'll get away with it. Either they're that, or they did recognize it, and they were making pointers out, but the message was lost. And I don't know the detail of that, and I suspect I never will. So to make sure that it's not the second one, we have to reevaluate where the Asset Liability Committee sits with respect to the overall governance framework. That's why it's on my priority list, okay? And it's not just that bank. Like I said, that's why I referenced this obscure paper from 2024. If you look at all the banks in that setup, they all had that same ALCO structure where it's 2, 3, 4 levels below the board. Now, someone else said to me, yes, but think of all the banks that had the same organization structure, the committee structure, but they didn't go bust. That far outnumbers the ones that did. So are you not making a kind of false positive conclusion? Not at all. I only have to be right once. You have to be right every single time. So if for the next 3, 4, 5, 10, 50, 100 years, no bank goes bust for balance sheet mismanagement, then you've got a point. I only have to have one bank failure with an inappropriate governance model and point to you to say that's an inappropriate governance model. So we need to reevaluate where the ALCO sits. The balance sheet is everything. We have to make sure that the stewards, the guardians, the managers, the owners of that balance sheet are the ones, we have to make sure that their message is heard at the right level in time. That's why it's number 2 or 4 on my list. Okay, the next one. The next one feeds logically on from the previous one. I'm going to call that risk culture. Now, some regulatory authorities have published on risk culture. They've written guidance on it. To their credit, actually, to their credit, because it's a challenge. It's a tough one. It's very easy, and by the way, the best case study for risk culture failure is Credit Suisse, isn't it? Credit Suisse. Credit Suisse. A G-SIFI bank, right? A G-SIFI bank. You know, their board populated with the great and the good. Their senior executive populated with the great and the good. Not just one regulator, the Swiss regulator, but the ECB as well, notwithstanding the fact that Switzerland is not in the Eurozone. But of course, it's such an important part of the European financial system, we can't let it go bust, can we? Credit Suisse, okay. If you type in Credit Suisse regulator fines into any search engine, you'll be impressed. Well, impressed, but not in an impressive way. You'll be impressed at how many instances come up on that list. Okay, year after year, that firm is getting fined by just about every regulator in town. The Federal Reserve, the PRA, the FCA, the EBA, what have you. Every regulator in town. There was one I didn't know about, actually. A friend of mine on the BTRM faculty. He's actually at Middlesex Uni now, at base, but he was at Lehman Brothers for 15 years. But he spent time with Manufacturers Hanover. I think it became Chemical Bank later. He spent time with Manufacturers Hanover in Tokyo. And he said, oh yeah, and I was talking to him about Credit Suisse, all these fines, all these, you know, I mean, the Mozambique tuna fish scandal. I mean, how poor must your risk culture be if you can't spot getting into some scandal involving tuna fish and an emerging market sovereign authority, okay? So he was telling me about in '96, the Japanese government stripped them of their license. Their Tokyo arm was stripped of its license for some nefarious practice. I didn't even know about that one. I'll add that to my list, Ed. Thanks very much. Okay, so, but optically, they were in good shape. Optically, you know, they had everything, didn't they? They had the great and the good on the board, like I've said. They had consultants coming out of their ears. They had loads of regulators. They had the policies, the 3 lines of defense. They had the procedures, the risk management frameworks. They had everything. Optically, to look at it on paper, it was as well managed as any bank. I know about G-SIFI banks' risk management frameworks and how onerous and comprehensive they are. I spent 4 years as a divisional treasurer at Royal Bank of Scotland. Now, in those days, that was a G-SIFI bank. I mean, when they were bailed out by the UK government, their balance sheet was more than 2 trillion. 2 trillion sterling, mind you. 2 trillion sterling. That's a big bank. So anyway, I'm aware of the onerousness, you know, the depth of scrutiny that goes into the risk management framework, personally aware of it, right at the coalface, that goes into the risk management framework of a G-SIFI bank. There's a lot. There's process, there's policies, there's procedure. It's intense. In fact, the last 7 years, I've been no longer in full-time. I'm a non-executive director. I've been a non-executive director at a number of banks in the UK and abroad. And if you asked me, what is the one item a board director spends more of his or her time on than any other item, it's regulatory compliance, making sure you're covering off all the things you need to do to comply with regulator requirements. So it's onerous, okay? That didn't stop their business model becoming, this is Credit Suisse, but I suppose you could say that about RBS as well. That didn't stop their business model becoming unviable. Their shareholders losing confidence and the firm being sold to UBS, which I'm sure UBS was happy about. Now, why am I giving you this as a case study? It's the fantastic case study in poor risk culture. How optically everything looks good on paper, but in practice you're not actually doing it. That's why I said it's credit to these regulators who've published on having the need to have the right risk culture in place in a bank, because it's actually very hard to write about. It's very easy to stand up and say, this is how we should do this. It's very easy to publish a paper on IRRBB. That's no problem, is it? Here, you just estimate your next 12 months' earnings and then shock that. And you estimate your net present value and shock that. That's easy to write about. It's easy to teach. It's easy to do PowerPoint slides on, okay? But culture, that's a lot harder to teach and talk about. How do I get the right risk culture in place? Someone asked me that the other day, and I said, well, let's start by having the right people there, okay? Let's have the right people at the levels of at the relevant levels of senior executive authority, so we don't need to worry about risk culture because they're doing the right thing, okay? If you see someone, the best example was Citibank back in 2008, wasn't it? But others as well, I guess. If you see the senior exec flying around in private jets, chances are the risk culture is not the right one, okay? But you can have poor risk culture and be nowhere near a private jet, okay? But you'll need to observe it before you can identify it. It's quite hard to write about and teach, but it's very, very important. So that's why it stays on my priority list. We've got to get the risk culture right. And that's one of these things where this expression tone from the top really is relevant. You get the right people at the top who demonstrate the right risk cultures, and then as chances are people will understand risk management better. That's why it's good that some of the pushback over the last 20-odd years, there's 3 lines of defense. Nowadays we call it 3 lines model, don't we? All regulated, as far as I'm understanding, every regulator in the world expects to see the risk management framework of a bank that it supervises couched in the 3 lines model framework, okay? So it doesn't matter what we think of it, whether we approve it or like it or not, or think it's any good or not. We have to build our framework around that. So that's fine, we've got to do that. But let's change the culture. Let's change the culture from one that says risk management is the role and responsibility of the second line of defense, and we're here to do business. Let's change that to we are all risk managers, every single one of us. And the first line actually owns the risks. You're the responsible, accountable authority, you in the first line. In an ideal world, if I had all the right people around the table, I wouldn't need a second and a third line defense, would I, in an ideal world? Because the first line would just take care of it. I mean, I would need an external auditor because the shareholder wants someone to say, oh yes, the financial books and records are accurate. No one is trying to rip you off, okay? So we need that external auditor. But in an ideal world, in a utopian world where we were all doing the right thing, we wouldn't even need a risk management function because the first line would just take care of it. Risk limits only mean anything if you actually adhere to them, if you actually observe them. I've got lots of war stories on this, but this is my favorite. Here's my favorite. In fact, one of my favorites involves a bank I didn't work at, Barclays, and their ETF business, which was consistently found to be over the limit, but it was only reported at the top level once they started making losses in that business. I read about that in the Times. Must be true. But my favourite story of risk limits involves, again, good old Royal Bank of Scotland. So after I'd got there after the bailout, but only very shortly after the bailout, and I was looking at some of their ALCO minutes, and they had a metric. The investment bank had a number of liquidity risk metrics, as we all do. They had a risk limit, which was share of funding by short-term wholesale funding. There was a risk limit. And we had lots of liquidity risk limits, we all do. Sorry, I've got an aside now, which reminds me of another story. I was teaching a course at one of the US bank subsidiaries in London on liquidity risk, and just before I started, I was chatting to the CRO. And he was saying, oh yeah, we got a suite of liquidity risk metrics and such. We've got over 300 of them. 300? I thought, okay, great, good one. And I was thinking to myself, you could lock me in this room and say, Moorad, you are not allowed to come out until you have listed 300 liquidity risk metrics. And I'd starve to death because I wouldn't be able to come up with 300. 300? Who needs 300? So have you heard this English expression, you miss the wood for the trees? You could be the most complicated balance sheet in the world, and I still think you can do a good job with about 30. He had 1 0 too many. Anyway, back on track. My favorite story about limits not being respected or observed in plain sight is this story from RBS. So they had this limit, short-term wholesale funding as share of total non-equity funding. And then a limit for it, X. And every month for about 8-9 months in a row, ALCO would turn up for the meeting and the limit would have been breached. Oh, we're over it. We're in the red zone. Okay, can we increase the limit then? Okay, fine. So they would increase the limit so they were now back to green. And then every month, they were increasing the limit, so they're back to green. Now, what do we think about that risk culture? It's not really taking it seriously, is it? So it doesn't really matter what you've got written in your policy document or in the terms of reference or in the blah, blah, blah. If you're actually not taking it seriously, it doesn't help you. The limit could be anything, okay? I mean, the speed limit on the road when you're driving your car, it only helps you if you would adhere to it, right? You know, I crashed the car, I was doing 120, but the limit's 70. It's the limit's fault, right? But you were the one that was driving at 120. Ah, okay. Right, so risk culture has to stay on everyone's priority list because if it's the wrong one, and it could be subtly wrong. No one's going to admit to saying we've got poor risk culture. It's going to be subtly wrong. So we have to be able to identify it. Okay, on to the next one. So I've done, on to the next one. Now this one has to be on our list because lots of people are going on about it. Stable coins, you know, stable coins. Apparently, from what I'm reading, they represent a bit of a challenge for banks. Because what if all our tokenized deposits? Lloyds Bank in the UK, which is a SIFI bank in the UK, Lloyds Bank, big bank, traditional, been along a long time. Loads of chums of mine have worked there. A good outfit, actually. Their downfall was being bought HBOS, Halifax Bank of Scotland, in 2008, because the government didn't want to bail out HBOS, because they'd just bailed out Royal Bank of Scotland for 35 billion taxpayer money. So they sold it to Lloyds, but of course Lloyds acquired it, looked at the balance sheet, and that balance sheet wiped out the whole group's capital base. Anyway, so Lloyds Bank has introduced this year, I believe, or was it last, a tokenized deposit offering for its customers. I don't know, and by the way, they're not the only example, there's others. Stablecoins, they're a challenge for banks, apparently, because if all our customers, and if they start paying a yield, blah, 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 you know, and I mean, there's not many, there's less than, I don't know, less than 5%. There's a very small minority of stablecoins that are not in dollars. I mean, they're mainly US dollars. But if customers start wanting to hold that and tokenized deposits, we're going to see our deposit base go out the door, aren't we? So that should be a priority list, but not a priority list from a risk management point of view, I'm thinking, more from a strategic point of view. And only if we think it's going to hit our customer franchise. I mean, I could be walking down Bishopsgate in London, in the city of London, EC2, and I could stop 100 people and say, you're thinking of moving your savings into stablecoins? And maybe 5 of them would say, yeah, 100% Moorad, I'm going there. And the other would say, what do you on about, Moorad? So it depends what we think of it. But it would be remiss of us not to have it on our radar in case suddenly, for some reason, it takes off. I'm slightly skeptical, but it's such early days for me, I'm just keeping a watching brief on it. I don't know how it's going to pan out, okay? I mean, there are banks today in 2026 that don't have a mobile app offering. There are banks today in I know them, I'm aware of them. There are banks in 2026 that still require one to go into a branch to effect a withdrawal. Yes, I know what you're thinking. Well, not in Finland, right? But remember, the world has 200 countries in it, more than, okay? There are banks today in 2026 that are not doing all the things that other people tell me I should be doing. Stable coins, AI, I'll get onto AI, blah, 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 okay? They still write checks. You know, you still have to telephone up or go into a branch. There are banks that can survive without having to be right at the cutting edge of technology or the latest product offering. Absolutely. And why should they? If your customer franchise is happy, stick to it. The risk management stuff I was talking about up until now, that affects every bank. That's important for every bank in every country, all 200 countries, okay? But with stablecoins, it depends what we think of it. Now, why is this relevant to the ALM discipline or the ALCO governance oversight? Because, of course, in theory at least, and some people are saying to me in practice, it's going to be hitting your deposit, your funding, your deposit base, your funding structure. So, well, hold on a minute, that is definitely right up in ALCO's wheelhouse, isn't it? My funding base, my deposit base, my customer base, my depositor behavior. So having an idea before it hits my balance sheet of what might happen with stablecoin offerings or tokenized deposits, I think is in our benefit. So if I had a 3-year time horizon, I'd think, right, we want to just check whether we should be in this game or whether we should look to understand what our customers want, just so if there is any impact, our funding position has mitigated it. We've mitigated it either with a similar offering or other replacement or other alternatives. Okay, so that's why it's also on my priority list. So, coming to the 5th one. Or do I mean the first one? Right. Now, top 5 priorities. Number 1 priority, liquidity risk management. You're rolling your eyes. How is that a new priority? That's a 500-year-old discipline. Ever since the first modern banks, there are banks in Europe. There are banks in Europe that can trace their history back to the 16th century, 15th century. It's a 500-year-old discipline. And from day one of the first banks, understanding and managing your liquidity risk has been your top priority. Why is it on my list today? Because it never leaves it. It never leaves it. Have you guys been watching the Dune? It's the 3rd one out this year, right? Dune, Frank Herbert, Dune? No? I mean, I read the book as a 15-year-old. The book is phenomenal, by the way. It dates from 1965. To have all those ideas in your head in 1965, unbelievable. Frank Herbert is the author. So I read the book as a 15-year-old, and there's an elegant expression, the water of life. Now, I have misapplied that expression in banking. Liquidity is the water of life for banks. We get that wrong, we fall over in a weekend. Okay, which by the way reminds me of something else. Recovery planning. Very quick aside, I hope you don't mind, very quickly. Time on the clock, no problem, I'll get this. Recovery planning. So we have our ICAP, we have our ILAP, then we have our recovery plan, then we have our resolution plan, recovery planning. And then we had, in 2023, we had 3 different jurisdictions where banks failed. In the US, with our 5 banks, our 4 failed banks. The 5th one you won't know about, Kansas Tri-State Bank. Do we know about that one? That failed because their CEO just embezzled all their capital base. Good old-fashioned bank failure reason, right? But the other 4 we know about, SVB, First Republic, Signature, and Silvergate, okay? We had 4 failures in the US. We had SVB's UK sub, which is regulated by the PRA, the Bank of England's PRA, and we had Credit Suisse. Now, in all 3 jurisdictions, the banks went essentially from BAU, business as usual, on a Thursday afternoon to resolution on the Sunday. Okay, they were resolved. They went from green to resolve in a matter of days, right? No invoking the recovery plan. No triggering of the recovery plan. No time to implement the recovery options. So painstakingly detailed in 200-300 pages of your recovery plan document, for which 4 out of 5 banks would have paid consultants a whole chunk of cash to help them draft. Okay. By the way, consultants love, no disrespect, they love a bit of Basel guidance, right? Okay. So recovery planning, maybe we should rethink about the value of those. Come back on track. So where was I? Liquidity risk. Okay, it's the water of life. We get it right. We need to get it right 365 days a year and 366 days in a leap year. We have to get it right every day forever, unless we have some medium-term objective to wind ourselves up at some point in the future. We don't. We are merely temporary guardians of the balance sheet. We are temporary stewards. We pass it on to the next set of senior execs who replace us, and they pass it on to theirs. They are temporary stewards. We, you, me, us, all of us. We are but temporary guardians of the balance sheet, okay? And we have to get it right. We have to maintain long-term viability and resilience. Liquidity risk is always on the priority list because it can never go away. We can never relax on it, okay? And we saw that in 07, in 08, 09, and again in 2023. Now, one of the things that I took away from the failures in 23 was the need for a short-term LCR. Now, you can have a liquidity coverage ratio that's very healthy. It's a 30-day metric. But if the bank run hits you in 3 days, like SVB, then, of course, having it above 100 doesn't give you any warning or indeed any resilience. You need a short-term LCR. I actually adjusted it to liquid cash ratio as opposed to liquidity coverage, because I think if you're a bank that has deposits at other banks that are SIFI banks, then you can assume that in the next 3 days you can get the money out. They're not eligible for HQLA under Basel rules, but for me in an operational situation, I'm going to assume I can get it. It's an internal metric. There's no regulated guidance. Was there? Is there any regulated guidance? There is now. There is about to be. So I published something in 2023 saying we need a 3, 5, 7-day LCR. Pick it. You pick it. 3 days, 5 days, 7, but we need a sub-7-day worst case stress scenario LCR coverage, and we need that to be above 100%, okay? And in March this year, the PRA published a consultation, CP 526. Yeah, I really need to get out more. BCBS 368 5/26. I need to get out more. They published a consultation called Modernizing Banks' Liquidity Risk Frameworks. I like the content of it. One or two of it is just stuff they're repeating from before. You need to be able to understand what the last resort process is when you call up for funding at the central bank. They also said banks need a short-term liquidity stress metric. And I thought, no one's going to disagree with me now. Not with the PRA saying it, 3 years after I said it. I mean, did they read my paper? Did they see my YouTube video? I don't know. Maybe they thought they came up with the idea themselves. They may well have. Okay. Apparently, Black-Scholes came up with the idea of option pricing at the same time that Merton did. Okay. So, great. We want to have the bank stand alone, self-sufficient for funding at all times. I was presenting the ILAP once to the PRA back in 2013 for Royal Bank of Scotland, and the guy, they were opposite me going through they were going through the contents, and one of the things they said was, we're trying to remove the stigma associated with drawing down on central bank funding. They have something, it's very common in developed economies where you have, in the UK it's called the discount window facility. You know, you pre-position your collateral, then you need to draw down on it, you get same-day funding for up to 30 days, payable at base rate. We're trying to remove the stigma associated with drawing down on DWF. I thought, great, fantastic, good on you, all power to your elbow. Pardon me if I never, ever want to draw down on it as long as I'm the treasurer. My old boss at Hawker Securities, my first job in the city, a long time ago. I had hair on my head, long time ago, 1991. Not my first job in the city, my first job actually in a bank. He said, he was the treasurer. He said, I only ever want to call the Bank of England. Well, actually, he said, I never want to call the Bank of England. But I only want to call them at Christmas to wish them Merry Christmas. So once a year, every December, I'll call the Bank of England. Otherwise, I never want to call them. What did he mean by that? He meant we're going to have a standalone, self-sufficient balance sheet for liquidity risk, which means under any conditions, at all times, we will always be able to maintain funding. We will never want to call the central bank for funding, because if it means we've failed. If we do that, if we're calling the central bank as lender of last resort, we've failed in our job. What was our job? To be guardians of the balance sheet through thick and thin. So liquidity risk stays on our radar. The only thing I would say to you now is do consider a short-term metric. You all have mobile app devices for your customers. That's what SVB suffered. They suffered instant outflow of cash, social media wildfire, 35 odd billion out the door in 72 hours. So we need a short-term LCR metric. But don't take my word for it. Just have a read of the PRA's CP 526. Okay, now if you've been counting, here's still a priority item from my ALM list. You're thinking, hold on a minute, he's run out of his top 5. There is a 6th one, because otherwise people would say ignore the elephant in the room. I would like to think I would never miss an elephant in the room. In fact, I'd like to think I'd miss a mouse in the room, let alone an elephant. AI. Everyone is going on about AI. I'm going to retire. I don't know. In fact, I don't need to be on top of AI because I'm looking forward to retiring soon. But we need to be on top of that for all kinds of reasons. Now, as Treasury people, as balance sheet risk managers, we can use AI for a number of, I think, value-added purposes. Your ALCO MI pack, a summary dashboard, ideas for stress testing, creativity, comparisons, asking for a suite of different ideas to compare against, model risk management. You know, we can use it for a lot of things. Equally, on the other side of model risk management, we want to make sure that if we are making use of AI for all kinds of reasons, agent AI as well, that our model risk governance and our model risk management processes stay on top of that. They stay in touch with it, okay? Because what I'm observing in banks is the use and adoption of AI is running ahead of the model risk governance framework in the bank, which is struggling to keep up with it. Keeping the human in the loop is something I firmly believe in, okay? Even if where agent AI is used to assist, to undertake customer processes, keeping the human in the loop is very important, and that ultimate responsibility and accountability as well. But that said, there is a lot of value add that can be brought to the balance sheet manager's table by the adoption and use of both generic and agent AI, as long as we are fully aware of the risks the potential risk that use represents. Okay? So in that respect, we don't want the model risk management framework to be trying to catch up with the adoption of AI. anywhere in our bank, not just for ALM purposes. We want it to be in touch with it as well and keep up with it. Otherwise, we do risk some further blowout later on. Okay. So the sharp-eared amongst you would have said, well, he said top 5, but there were 6 things there. That's true, but that's because I couldn't ignore the elephant in the room. And I look at the timer and I say, I have precisely 58 seconds left, which means that's 58 seconds for me to first thank you for your attention. I hope you found that interesting. Please forgive the footwear and, well, enjoy the rest of your day. My thanks to the hosts again. Enjoy the rest of your day. Thank you very much.
Thank you. Thank you, Moorad. Now it's a perfect time to present questions. Do we have any questions? Come on, people.
That's a result.
You know, we Finns are a bit shy sometimes. Olisi oikeastaan aika hieno tilaisuus nyt, jos jäi mitään kysyttävää meidän kansainväliseltä puhujalta. Anything? There is a hand.
I was hoping I could get away scot-free.
We have a question. Okay. Yeah. Please.
Hello, so I'm Ritva Aula from OP, and I'd like to ask, in your list that you had the most important thing was AI, and I'm the data person, so I think data should be mentioned as well, because I think AI will not tackle it very soon.
Great question. First of all, it wasn't actually the most important. The most important was liquidity risk.
Okay.
They were in my 5. I just tacked it on at the end in case I got accused of missing the elephant in the room. But you're spot on. The data analytics challenge, or data full stop, is a big challenge for the bank as a whole. And it's very pertinent to the Treasury and ALM function, obviously, but for the bank as a whole, completely agreed. It is a big challenge. We have to get hold of it. We have to understand it. We have to understand the risks there, the completeness, the accuracy, assumptions around it, the use of it, inputs, outputs, everything to do with data is right up there on the bank's priority list, as opposed to necessarily Treasury and Finance, because Treasury and Finance are reliant on what the CTO or CIO would. Well, the Americans mean Chief Investment Officer. I meant Chief Information Officer. What is in their space impacts them directly. So my short answer to you would be yes, absolutely. It's on the list.
Okay, thank you.
My pleasure.
Thank you. And please raise your hand if you have any question. Täällä on vähän kirkkaat valot, mun pitää siristää täältä. Okay. So,
Thank you.
I think it's time to say thanks a lot.
Thank you. Thanks very much.
Hyvä yleisö, annetaan isot aplodit. Juuri näin.